Okay, so something just happened in the silver market that, well, I think almost everyone is misreading. It's a huge signal that points to this massive disconnect between what the financial world says silver is worth and what people are actually paying for it in the real world. Let's dive in and unpack this.
Overnight, the paper price for silver on the COMEX, the main futures market, it didn't just climb, it gapped up more than 5%. Now look, that's not some gentle drift higher. That is a violent overnight repricing. And while most traders are going to see this and just write it off as a, nice technical bounce, they are completely missing the real story here.
And that really brings us to the central question of this whole explainer. Is this just some random noise, a simple price bounce, or are we looking at the first crack in a dam that's about to break? The answer, it turns out, lies in a tale of two completely different prices for the exact same metal.
So let's get right to it and really understand the core conflict that's driving this entire situation. We're talking about a massive and growing gap between the paper price and the physical price of silver.
I mean, just look at the sheer size of this disconnect. The COMEX paper price, even after that big 5% jump, is sitting around $76 an ounce. But if you want to go buy actual physical silver in Dubai right now, you're going to be paying $96. That's a $20 gap. A $20 difference between what the screen says it's worth and what it actually costs to get the metal in your hands.
And this isn't just some weird thing happening in Dubai. This chart shows you just how global this disconnect is. Check out Russia. They're pricing physical silver at $98. It seems like the entire world is pricing physical metal way, way higher than the paper markets. So what exactly are these two markets?
Okay, first up, you've got the paper market, and the COMEX is the king here. The best way to think about this is as a market for promises. It's where traders bet on the future price of silver, often with huge amounts of leverage, but very, very little physical metal ever actually changes hands.
And then you have the physical market. This is the real world. This is where actual silver bars, coins, and pellets are bought and sold. This is where the manufacturers go to buy the raw materials they absolutely need to build everything from solar panels to EVs to medical devices. This is the market of reality, not promises.
So why? Why did the paper price crash so hard recently, while the physical price just shrugged it off and stayed high? Well, this brings us to the illusion created by the paper market. It's driven by these weird mechanics that have absolutely nothing to do with actual supply and demand.
See, for these huge financial institutions, December 31st isn't just about New Year's Eve. It's a massive regulatory deadline. It's when they have to report their balance sheets. And to make sure they look clean and tidy for the regulators, they're often forced to sell assets in the days right before it, specifically on a day like December 29th. Then, once the clock ticks over into early January, they just start buying all those positions right back. But why silver? It's not because they're suddenly pessimistic about it. Nope, it's purely for accounting reasons. They sell what's easiest and quickest to offload, and silver futures are incredibly liquid. Plus, they consume a lot of balance sheet capacity because of these daily margin rules. So it's one of the first things to get chopped for compliance. It's a mechanical sale.
And this wasn't just some isolated thing in the silver market. It was a system-wide stress event. We saw all these warning signs. The SOFR rate, that's a key lending rate between banks, it actually traded above the Fed's emergency loan rate. That almost never happens. It's a huge sign that the financial plumbing is clogged and institutions are being forced to sell things not because they want to, but because they have to.
Okay, so now let's pivot to the other side of the story. Because while the paper market was convulsing from all these mechanical issues, the physical market was telling a completely different tale, a story of real scarcity and real urgency. And here it is. Here's the catalyst. China, which refines something like 70% of the world's silver, has announced it is banning all silver exports starting January 1st, 2026. Let me say that again, not restricting, banning. The world's single largest processor is about to shut its doors to the rest of us.
And this has triggered absolute panic buying among industrial users. This is not speculators trying to make a quick buck. This is procurement. These are manufacturers desperately trying to secure the raw materials they need to keep their factories from shutting down. Price suddenly becomes a secondary concern when your entire production line is at risk. And we have to remember, silver isn't a luxury item. It's a critical component in pretty much every piece of modern technology you can think of. We're talking solar panels, EVs, all of our electronics. These industries require a steady, reliable supply of physical silver. This demand is what we call inelastic. They have to buy it, almost regardless of price.
Now,
I know what some of you might be thinking. Hey, I've seen this movie before, back in 1980 or maybe 2011. But it is absolutely critical to understand why today's situation is fundamentally different from those past speculative rallies.
This table really breaks it down. Back in 1980 and 2011, the core problem was too much speculative leverage chasing a perfectly adequate supply of metal. The driver was just paper speculation. Today the core problem is there's simply not enough metal to satisfy real industrial demand. The driver isn't speculation, it's panic buying from manufacturers facing a genuine structural shortage.
And here's the kicker. You can stop a speculative rally dead in its tracks by raising margin requirements and breaking the leverage. And that's exactly what the exchanges did in the past. But you cannot solve a real-world physical shortage with paper market rules. It's that simple. You can't print more silver.
So, where do we go from here? That 5% jump was a big signal for sure, but it's just the beginning. Let's talk about the key indicators you should be monitoring to see how this incredible story unfolds.
All right, here's your checklist. First, keep an eye on those physical premiums. Do prices in Dubai, Russia, and other places stay this high? Second, what happens when China's ban is actually enforced? That's a huge one. Third, does the COMEX paper price continue to gap higher, trying to chase the physical price? Fourth, watch for news of any large industrial supply contracts getting signed. And finally, watch the gold-to-silver ratio. If that keeps compressing, that's the market screaming that silver has a unique scarcity problem.
Ultimately, this whole thing leads to two potential paths. Path 1 is kind of orderly. The COMEX paper price just slowly grinds higher over the next few weeks and months to meet the physical price. But Path 2, that one's more chaotic. The physical price completely decouples and just runs away, leaving the paper market behind as an irrelevant sideshow. And if a major commodity market like silver breaks, it calls the pricing of everything else into question and could create much broader financial instability.
Which brings us right to our final question. The gap between paper promises and physical reality is now just undeniable. That 5% jump shows the paper market is finally starting to wake up. But the question is it waking up fast enough? The next few weeks are going to tell us whether the paper market can successfully chase down reality or if reality is simply going to leave it in the dust.